All right, so we're up to class 24. We want to finish up pricing these products like we did. We were starting the last class. Get into joint life insurance, which is a very different type of product. The way we're going to price it, we're going to keep it simple because it can get pretty complicated. There's a few charts in the notes on a few articles on mortality rates and mortality tables, some interesting statistics. And if we have time, we'll get to benefit of survivorship. So last time we were talking about this particular product. It's a new annuity product. It was issued age 35. They pay up an upfront premium. That's probably what we're trying to figure out, that upfront premium. It then pays $50,000 to anyone alive at the beginning of age 60, and it also pays back the original premium to the states, because this person's already died. Anyone who's died between ages 35 and 60. It pays another $5 million to anyone alive at age 90 at the beginning of the year they turn 90. So if you think about it, they're going to get a premium at age 35, and they're going to pay all of that back at age 60, which means all they're going to have left is the investment earnings they made between 35 and 60. They're not going to receive any more premiums, and then at age 90, they're going to pay these people $5 million. How in the world, if you think about a product, I kind of like how this is built, because people say, well, at least I get all my money back, whether I'm dead or alive, I'll get my money back. Assuming the premium is less than $50,000. If it's more than $50,000, they won't get all their money back, but we'll see. And so, we're really, time value monies are really huge here. The discount rate's 5%, so that helps a lot with a higher discount rate. Probably wouldn't be as possible today. So we got L35, so let's go get L35 off our table. They're going to be paying that initial premium. And then we have L60s. Now the L60s is going to tell us who's still alive at age 60 to get the $50,000. But then we know that L35 minus L60, we have 14,000 people that are going to get the initial premium back. And then the L90s are going to get $5 million. Wait, so the L90s will get 6,000 people, or they're going to get $5 million. That seems pretty incredible. The ends here, remember, because everything's happening at the beginning of the year. Even these dyers, they're getting the money, their estate is getting the money at the beginning of the year they would have turned 60. And so because of that, we just have to take 60 minus 35. That makes our end 25. If our death benefits at the end of the year, we would do 26. Same thing with the L90s. We're going to pay that $5 million at the beginning of the 90th year. So we know that our N is 90 minus 35 or 55. So that makes it really simple. And so L35 times the $50,000, that we're going to pay in 25 years. So we discount, so that's our payment. And then the L35s minus the L60s, there's 14,000 there, times the original premium equals, back 25 years, plus we're going to pay the L90s $5 million, and we discount that back, and all of that is divided by L35. So that's going to give us our premium. So what we need to do is somehow get that premium. So all of this is going to equal the premium. All right. So we have the premium in there twice. So let's think through how we can actually. Now, if you got that far, you would actually get quite a bit of credit just for setting that part up right there. So at least go that far. So why don't we have what we have here? Let's take the L35. Oh, I did that wrong. It's not L. Sorry, boy, there's a typo there. You're probably wondering where I came up with it. It's the L60s. I don't know why I said that. So L60 times 50,000. Sorry, I don't know what I said last class. I might have been thinking L60 and typed L35. So L60s. Whoever's alive at age 60 gets $50,000. Sorry about that. L35s minus L60s, that's the number of people dying. They'll get their premium back. And then the L90s, so everything else looks good. So let's try getting each one of these. Let's just do it one at a time. So the L60 times $50,000 divided by 1.05 raised to the 25th. So our premium needs to cover that. It's a huge number, but that's okay. And then we're going to have the L90 times $5 million divided by 1.05 raised to the 55. Our premium has to cover that. So if we add those two things together, we're going to have that plus L60 minus L35 minus L60 times the premium divided by 1.025 to the 25th. So this is going to be this plus 14,565 times the premium divided by 1.05 raised to the 25th. So it's going to give me an error message. I hit escape. All right, let me fix that again. So we're going to have all of that is going to be added to that. We're going to divide by the premium, and this whole thing will be divided by L55. So so let's take this divided by L35. I'm sorry, L35. So that's how much the premium would be for that portion of it. And so what do we have left? That plus 14,565 times the premium divided by 1.05 raised to the 25. This and this divided by L35. That all has to equal the premium. So let's see if we can simplify this some. So let's take 14,565 divided by 1.05 raised to the 25th divided by L35. And that gives us 4%. So we have $35,819.15 plus the premium times that equals the premium. So let's move this over to the side. So we have the premium minus 4.3787% times the premium is going to equal 35,000. So let's take, so we've got 1 minus that. That gives us 0.95 times the premium equals that. So we'll divide both sides by that. And that gives us our premium is 37,459.39. Let's see if this actually works. All right, so let's think through this again. So it's just good old calculus. So we figured out the L60 times $50,000. We knew that number. We discount that back to the present. That gives us that. We know the L90s. That's $5 million discounted back. So we know that value. So the sum of those two is that. We divide that by L635, and we know we need at least 35,1915. So the only thing we're left with is how much more does the premium need to get, so we actually pay the premium back. And so we know 14,565, those are the people who died, times the premium, what we're trying to figure out, that brought back to 1.05 to the 25th, divided by all 35. that has to equal the premium. So let's do everything but the premium. So when you do the math of all of that, you get 4.3787% times the premium has to equal the premium. So the premium minus 4.3787% times the premium has to equal 35. So if I set this up, 35,819.15 must equal the premium minus 4.3787% times the premium. That means 35,819.15 must equal 95.6213% of the premium, which means the premium must equal 35,819.15 divided by 0.956213. Now, it may be a little bit off because of rounding. I didn't round here, so that's the exact number. And so that's the formula. So we just figure it out, and we get 37,459.39. Now think about it. If that's the right answer, we'll check it here in a second. But if that is the right answer, the people that live get an extra $12,000. Think about that from a marketing standpoint. At age 60, you'll pay us $37,000 a day. At age 60, we'll give you $50,000. Now, is that a good return? Probably not. 50,000 divided by that and raise that. What do we say this was? Raise it to the what? 25. 1 divided by 25 minus 1. All right, I did something wrong. So 50,000 divided by, I did 500,000. That's probably the problem. 50,000 divided by that. It's a 1.16% return, but given where inflation is right now, that's not a very bad. That's not a bad return. And so yeah, so they're guaranteed if they live, they'll make 1.16% on this. Now, if they die anytime later, that's all they get. They'll make 1.16%. If they die, their estate makes 0% because they're going to get exactly 37,459. But boy, that just seems incredibly powerful. And then if you live to 90, you'll suddenly have $5 million showing up. We're going to talk about this, benefits of survivorship. We see this on the life insurance side where you pay $35 and if you die, you're going to get $1 million. Wow, that's a huge return. We can see the same thing on the other side. It's people who live a long time get huge payouts from these longevity products. That's why I like them so much. I just wish they would be designed more like this one. So I'm thinking this one entirely from a marketing standpoint. So it's hard to get people to pay $37,000 up front, but if they know no matter what, they will get all of their money back. You know, a lot of people, you say, well, you got to talk about the time value money. Yeah, time value money is very important. For most people psychologically, if they say, you tell them they'll get all their money back, so a 0% return is their worst case, for a lot of people, it's very psychologically appealing. Even though we're talking about 25 years. Over 25 years, you'll make 0%. But if you make it to 90, this thing will save you. If you didn't save enough for retirement, this thing will absolutely save you. Yeah, you're going to be out $37,000 at age 35. Who has that kind of money at age 35? But yeah, I mean, it's you know, we could shrink it. We can make it $4,000 and you only get $500,000 and you turn 90. So we could definitely scale it to whatever size this person can afford. But let's test it. So over on the side, I've got this already set up. We'll start at age 35. What happens at age 35? Well, we're going to go over and get the L35s, 98,227 of them, to pay this premium. We don't have any claims, so I'm going to type the claims as a negative number when we do pay it. Everything's at the beginning of the year, so I'm going to take all three of those added together and multiply by 1.05. That becomes my beginning balance, and we just keep growing it at 5% every year, and that's huge with this product. Then at age 60, we're going to pay the L60s. These people, we're going to pay them $50,000. And the people who died between 35 and 60, we're going to pay them the original premium. And so there's the original amount. So this portfolio, you say, well, how do we have any money left? We're paying everything back plus an extra $12,000 to most of them. But because we're making 5% and most of them are only getting 1% and then a fraction we're getting 0, we still end up with a fairly massive portfolio. Then we move along, nothing happens, and then suddenly at age 90, we're going to pay the L90s each $5 million. And at the very end, you have nothing at the very end. I think Bill Gates says there's something there, but it's essentially 0. It's just a rounding issue with Excel. All right. So some students just panic on this and leave the question blank. What I'll do on the final is we'll probably do this question last. And it's a 5-minute question, but I'll give you a lot more than 5 minutes. Trust me on that. You'll get a lot more in 5 minutes. What I might do is give you maybe 20 minutes, but if you turn it in late, I'll still accept it, and I'll give you, you'll lose points if you turn it in late, but at least try. If you want to turn it in twice, turn one in on time, and then keep working on it, and then you discover you couldn't get any better, then you don't get the deduct for being late if your final answer is the same as the one you turn in on time. So you could turn in on time what you have, turn a second one late, and I'll look at the two scores. If your score turning in on time was a 63 and your score turning in late after deduction for time was a 53, I'll take whatever the higher score is. So I won't penalize you. So we'll see. We'll work that out. I know it's stressful doing exams that way, but it's good practice to make sure you're prepared. It's an incentive to be prepared in advance. We'll get another practice problem like this. We'll do one more. They're all I do them all differently, so I can't really show you an ultimate one. Just get some practice. So I might, I'll try to put some out on Blackboard that you can practice without the answer given to you and just see if you can come up with it. What I love about this, though, is that you can actually check your own work by you see how easy it is to just follow the problem here. Once you get the answer, setting up this schematic is really, really quite simple. You just put the age down, and at the end you got to decide whether the cash flow is the beginning of the year or the end of the year. If it's the beginning of the year, all of it gets 5%. If one of the cash flows is at the end of the year, you do the 5% just for those at the beginning of the year, and if it's at the end of the year, you just add it because it happens right at the end of the year. So other than that, you just set up the cash flows as they come, and you've got it. So pretty simple problem. All right, so our next problem is a joint life, and we're going to do these a little bit differently. So there's two types of joint life. One is it pays when the second person dies. So if the first person dies, it doesn't pay anything. When the second person dies, it pays, and essentially that's a policy to help pay with the state taxes. Most people want a policy that pays when the first person dies. And I would have liked, if we had more time in the class, I would have liked to actually give you an example. But let's think about this example. So this happened with my parents. So let's say the wife has a pension from an employer, and she has a choice. You can choose a joint pension, so it keeps paying the husband even after wife dies, or she can do single life. It stops when the wife dies. The pension is greater if it is single life. So that's pretty important. So she's given a choice, and I actually encourage you to do exactly this math. She's got a choice. So maybe the single life, maybe it pays $2,000 a month, or let's make it a little nicer than that, $4,000 a month. But the joint life pension, maybe it pays $3,500 a month. So if they do the single life, With the single life, they have an extra $500. So maybe with that extra $500, maybe they buy life insurance on the wife so that when she dies, and they're going to lose the $4,000 premium, pension, but they'll get life insurance. So, you should actually go out there. So the question is, how much life insurance could they buy? And I'm not going to answer that question, but it's actually not a very difficult question to answer. And then you got to decide and then how much income would that provide? So if you say, wow, I can get $300,000 worth of life insurance, and that will produce $2,000 a month of income, then that's pretty risky, because if the wife dies, the husband gets the life insurance, and so they do the single life, so they're getting $4,000 a month. But then the wife dies, so they lose the $4,000, but the husband gets the $300,000 insurance, but he can only get $2,000 of income a month out of that. Or if he could buy an annuity, it'd only give him $2,000 a month. That's pretty risky. If his wife dies, his income drops in half from her pension. However, maybe that $500 in life insurance would actually buy a $700,000 policy, and that might produce, say, $3,900. And they might say, or maybe it produces $4,200. Or even better, maybe instead of, the key here is if they buy the $500 in insurance, they're back to the $3,500 a month. So maybe they take $300 to buy insurance or $200 in buy insurance. And so instead of making $4,000 a month, they'll make $3,800 a month. That's still better than the $3,500, but how much insurance will that buy? And they may not do it so that they're always better off in all situations. So this might be one of those kind of stochastic dominance type of things. Maybe looking at the two people, you really expect the husband to die first. And in that case, obviously the wife would much rather have the $4,000 per month. But just in case the husband lives longer, they want to provide him some income to make up for that $4,000, but maybe they don't need it all made up. Maybe they'd be fine if they only make up $2,000 of it, and that would be perfectly fine. And maybe they spend $200 in insurance. That buys them enough insurance so they can replicate at $2,000 a month, because maybe the husband has his own pension, or maybe he has Social Security. So that's the kind of question you're looking at. And so joint life is usually the type of policy you would do here, because when the first person dies, there's a good chance a large income is going to disappear with a pension, and you want to replace that with a life insurance proceeds. Now, we're not going to go through the entire math of here, but you can figure out how to do that math. It really comes down to how much insurance can you get, how much of an annuity would that pay. And so I wish my parents had come and talked to me about this. They actually did it with the single life, and then they bought insurance with a difference. Unfortunately, they bought the worst kind of insurance. They bought a universal life policy that's just blowing up now. If they bought a whole life, it might have made sense. However, the amount of whole life they could have bought could not have possibly replaced the pension. And in that case, my mom is much more likely to outlive my dad. And in that case, I think they made a bad decision. They probably should have gone with a joint pension, because they could have easily lived on that with no problem. They could have adjusted to the lower income, and it's usually not a radically different income. But this is the type of math you should be doing. You might start asking your parents about this maybe in the next 10 or 20 years. Maybe they're too young now to be asking those awkward questions, but at some point you probably want to get into this conversation to help them to set this up. So we're not going to do something that complex. We're going to do an annual renewable term joint life just to keep the math simple, and we're going to assume independence. That is, one life death is not correlated with the other. And that's a pretty wild assumption. First of all, if they're flying together, driving together, there is some joint probability that they'll both die together. The other issue is often, especially with older people, when one spouse dies, the second one might die shortly thereafter. That's especially people in their 70s and 80s. So there could be some correlation there. I'm assuming independence, since it's a renewable term, that's probably not too bad of an assumption. If this were a 30, 40-year policy or whole life policy, it would make a bigger difference. And so what we're going to do is with the joint life, it pays if both or either dies. And it pays the same face. So if they both die together, they'll get $100,000 or $10,000. If the wife dies, the husband gets $10,000. If the husband dies, the wife gets $10,000. All right. So the only time it does not pay if both live, and that's a much easier number to get. Getting if both die or either dies, that's a lot of calculation. But the probability of them both living is just P for the wife times P for the husband. You remember P is the probability of them living or dying. So the probability of this, it's 1 minus the probability both live. And that's the easier one to do. So what's the probability they both live? Remember, this is going to be, so here's the example we have up here. Let's look at this example. The husband is 70. The wife is 90. Obviously, it's a really bizarre policy. The face is the 10,000. It's 5%. We're only doing this for 1 year for some reason. So what's the probability they both live? We want to take the face times 1 minus that probability they both live. And the probability they both live is P70 times P90. I didn't do that very well. Well, what is P70? P70, you have to remember back to our very first part of our pricing when we had all the symbols. The probability of someone living is L71 over L70. And the probability of the second one living is L91 over L times L over L90, L91. So this times this, L71 divided by L70 times L91 divided by L90. That is the probability they both live. 1 minus that is not the probability they both die, but the probability that one or both die. That times $10,000, and we divide it by 1.05 to the first. You might say, well, where's the premium payers? That's where we're taking account of it right here. We're dividing for the premium in the numerator rather than the denominator, and then we adjust for the time value of money. All right, so let's set this up. So what do we need? We need L70, L71, L90, and L91. So let's go get those numbers. L70, 64,000. L71 is 62,000. L90, we already saw that one before, 6683, and L91, 5201. So probability, and this is an important number, you're going to see why on the exam. Both live is going to be L70 divided by L71 times L90 divided by L91. And it's a pretty high probability. Oh, I did something wrong. Oh, I did it backwards. Excuse me. So the probability they both live is going to be L71 divided by L70 times L91 divided by L90. It's going to be a pretty good number. They have a 75% chance they both live another year. Even though one of them is 90 years old, they still have a pretty good chance of living another year. So that's the probability they both live. So what's our premium going to be? So if you look at the formula up here, it tells you the formula. It's 1 minus that times the face divided by 1 over the interest rate. So we just take 1 minus the probability they both live times $10,000 divided by 1.05, and there's the premium. It's a fairly significant premium because there's a pretty high probability one or both of them die. There's a 25% chance. So they're not going to pay $2,500. There is some discounting going in there, but they're already going to pay a pretty hefty premium, $2,400. All right. Now, what I want you to do on the exam, so you have to set this up and do the math. So So what I want you to do, if you look back at the class notes, I say compare this to buying 2 term policies. So 2 term policies, what would that look like? Well, 2 term policies, you have, for one, you have D70 times $10,000 divided by 1.05 divided by L70. You remember that formula, so that tells us that one. And then the same thing with the D90 divided by L90. So we can certainly do that. So let's do, so how do we get D70? So here's the D's. Remember the D's are just L71 minus L70 minus L71. And L90 91 minus, L90 minus L91, so there's the Dyers. The math here is going to be, all right, so the formula is going to be D70 times 10,000 divided by 1 plus 0.05 divided by L70. And then the next one's going to be D90 times $10,000 divided by 1 plus 0.05 divided by L90. We add those two together and we get 2488 R, a premium that is $83.46 more. So the question is, where did that $83.46 come from? So this is really important. I want you to actually on the exam justify that $83.46. And the difference in these policies is when both die. Because when both die, the joint life pays $10,000. But the 2-term policies are going to pay what? You're going to pay $20,000 because you get from each. So the key here is, what's the probability they both die? So that is going to be D70 over L70 times D90 over L90. So the probability they both die, it's got to be pretty small, but let's look at it. So we take D70 divided by L70 times D91 divided by L90. D90, excuse me, D90 divided by L90. That's the probability they both die. It's very, very low probability. And so if we take that times $10,000 divided by 1 plus 0.05, guess what we'll get? We'll get the $83.46. So $83.46, that's an additional $83 that you're having to pay for the scenario where both people die at the same time. A very low probability, and since it's a low probability, it doesn't add that much to the premium. So what does this mean? Well, if they don't need $20,000, if they both die, $10,000 is more than enough to pay for their estate, taxes, and everything else. $10,000 is plenty of money if they both die. It's very rare to happen. Save the $83, go out on a date, and you're good. However, if it'd be nice to have an extra $10,000, they'd both die, even though it's unlikely. It's only $83. So yeah, buy the 2-term policies. Now let's look at this, but let's look at a much younger person. Let's look at someone who's 25 and someone who's 29. So when we do that, let's see what the math becomes much different now. Because you know the probability of these 2 people dying is incredibly rare. And so we'll take the people dying, here's the Dyers. And let's bring all this down. I'm just going to copy it. Let's see if it works. So probability that both live is extremely high. What's the premium going to be? 1 minus that. The premium is only $33. That's not the difference. That's the extra premium. So let's do the two joint life. So that one's going to cost $16.86. And here you notice it's lower because we said 25-year-olds have a higher mortality than 29-year-olds because of driving. And so here we add them together. Our difference is 3 cents. Where did that 3 cents come from? Well, it's going to be D25 over L25 times D29 divided by L29. And that probability is incredibly low. And so there's only a 3 cent difference. So you would never, and so here's the key, you would never sell a joint life insurance policy to a 20-something-year-old couple. You're only saving pennies. Even if you make this a $100,000 policy, they're only saving 30 cents. Or $1 million policy, they're only saving $3. So it's just not even worth messing with it. So the few things on the joint life, first of all, you would never buy for younger people because the probability of both of them dying is extremely low, so you want that in your answer. Probability of both people dying when they're young is so low, there's no reason to even consider a joint life. For an older couple, buying a joint life will save them a little bit of money because the probability of both dying is much higher. It doesn't save a lot, but it does save some money. So the choice then becomes, do they care what happens if they both die together? Because that's the only difference. If they don't really care about that, then just save the money. Yeah, it's 80 bucks, but you're still saving 80 bucks. Keep it and use it for something else. But if there may be a benefit, if they both die, maybe they both die, they think that's really going to be a hardship on their children. So let's double up. In that rare case, let's double up and pay more life insurance so that our kids have something extra to help them through that period. That's fine. But that's the argument you make on joint life. So the key is you have to have know this formula. So it's a very simple formula, but it's still very different than everything else we've done. So it's 1 minus the probability they both live times the face divided by 1 plus the rate. We're only doing 1 year. You can see this could get really complicated if you go on in the multiple years. And you want to compare that to 2 annual term policies. So, you know, we did a 25 and 29. This is talking about 25 and 27. But if you buy 2 term policies, that makes a lot more sense because it's going to be 3 cents more expensive, but big deal, 3 cents more expensive. But the key in your answer is to say the reason it's so little difference is that the only difference in these 2 policies is if they both die together, and that probability is so low if they're both very, very young. So there's our joint life. And so in the notes it says husband and wife first to die, life insurance. If they die in the same accident, they get the same amount. If he dies first, the benefit goes to the wife. And so there can become some confusion here. So if they die, and so this is a first to die policy, you have to figure out who dies first. So if they die in the same accident, you have to actually go out and try and have the coroner or whoever has to tell you which of these 2 people died first. If it was an airplane accident, there's no hope, but they probably both died identically. But if he dies first, the benefit goes to the wife and then to the wife's children. If she dies first, the benefit goes to the husband and the husband's children. So this is, you know, a mixed family. If they die simultaneously, they'll probably split it among the children in some you know, probate way. But it can be a little tricky, and there have been some court cases related to this exact issue of who died first. Joint life is what we're talking about. Younger people should never buy joint life. They should just buy the 2 policies because it's very unlikely both will die together. Older people, it depends. You save a lot more money over buying 2 term, and that reflects the probability that you both die is much higher. So you have to ask, why are you buying the insurance? If it's entirely to help the surviving spouse, then save the joint life and buy this joint life and save the extra money. If it's for the surviving spouse and inheritance, or to cover estate costs, then you might buy the two-term and pay for the extra insurance, just because you might need that. But anyway, those are the considerations. Right now, what I want to do is jump into some final issues related to mortality tables, looking at, and really just life expectancy, looking at a couple of articles I found were interesting. One's a little dated, and I think this may be changing, and we'll see. We'll talk a bit about that. There's an article I was going to show you, but it's not, I can just tell it to you without you having to read the whole article, just to save you some time, so I'll just mention it to you. But this article is talking about how men don't live as long as women. Part of it is because men do more dangerous things, the testosterone. So part of it is men die in accidents more frequently because they do stupid things. It's also suicide is higher with men than women. So there's reasons for it, but there are some physical reasons too, heart disease and some other things. So this article is saying while women still live longer than men, men are closing the gap. Their longevity gap is not as long as it used to, but it is actually widening out here recently. We'll talk about that. But so women tend to live longer than men, but it's less true than it used to be. The gap is shrinking, especially in rich countries. In England and Wales, the biggest peacetime difference in life expectancies at birth was 6.3 years. That was in 67. Now it's 4.1 years and it's falling. In the 1980s, women who made it to 65, the traditional age for retirement, could expect to live 4 years longer than their male counterparts. The gap is now less than 3. I always joke that, if I make it to 90, I'll just move to the UK, because there's 7 women for every man at that age group. I think it's over 80, 7 women to every man. I mean, I could be the ugliest, boring guy in the world, but I got a 7-to-1 odds, and it may be the same in the US. I just remember seeing that article about the UK. Yeah, there's a lot more elderly women than elderly men, but the gap is starting to shrink a little bit. Here's an actual picture of the gap. You can see the gap is definitely since the 60s. Part of that could be that the improvement in longevity for women is slowed down because women have gone into the workforce, and the workforce is more dangerous than being at home, because you're driving to work and all these kind of things. And it's also maybe, I don't know if it's more stress. I think doing a homemaker might be more stress than the office if it involves a bunch of kids, but but it's possible the work life is more stressful, so there's more chance for people dying of certain diseases, stress-related diseases. So it might be, women are still, their longevity is increasing, but maybe not increasing as much as women enter the workforce. So this trend is superimposed on another, that life expectancy in most developed countries has been improving, but it's improving more for men than women. Part of this too, and I may say it in here, it has to do with some of our activity, some of our hobbies. Around half the difference in longevity can be explained by smoking. So there's part of it. Men smoke more than women. And so when people cut back on smoking, you definitely saw impact. So Russia bucks this trend. Why? Because their smoking is still very popular there. In Britain, when the habit was commonplace, men were more likely to be smokers than women, but they had also been more likely than women to give up cigarettes. Another fifth of the gap is explained by alcohol. In this case, the gap is widening. In 79, 2 men died from alcohol-related causes for every 1 woman. Now it's 2.4. So let me just say why the gap is starting to go the other direction and actually widening is opioids. Opioids tend to infect men more than women, and because of that, you're actually seeing life expectancies declining in men. It's pretty amazing. The first time in history that we're seeing people live, the next generation living shorter than the previous. Now, men who aren't on opioids, their life expectancy is longer. So if you take out drug use and alcohol use, life expectancy is actually, men are closing the gap on women and are living longer. But when you have the total population, it definitely is a bigger impact for men. The third important factor is obesity. Obesity may have a greater impact on women because it increases the risk of both hypertension and diabetes. And men are also closing the gap in another area, coronary heart disease. In England, deaths from this fell more than 50% for both men and women. But because heart disease kills twice as many men as women, since we're getting better at operations and bypasses, since more men die from heart disease, they're getting the bigger benefit of the improved technology in healthcare. Women have genetic reasons why they live longer. There's sections of the DNA protect the ends of the chromosomes from decay. Men's telomeres are shorter than those of women and also degrade more quickly. Testosterone is a hormone that is more or less defines maleness. It promotes both aggression and risky behavior. We talked about that one before. They are also more likely to kill themselves, so suicide is a difference. So there are things that go on, and so as you mentioned, opioids is another factor. This article I just thought was interesting just because it shows actuaries think about everything. Anything you can test, any kind of analysis, data mining, it's a bad term in finance, but in actuarial science, boy, you're just looking for a relationship, and then you'll explain the why later if you need to. So here's a study. A simple way to assess how likely someone is to die in the next few years is to test the strength of their grip. There is a good deal of national variation. Swedes have the world's firmest handshakes. Pakistan's the limpiest. I remember at work, there was the guy I worked with, he was actually from Pakistan, but he actually had an injury to his hand that made handshaking very painful for him. And there was a guy from Mercer Research who had these most tense grip, man. He just squashed your hand. And my coworker, boy, he hated. He just did everything he could to avoid handshake with this guy. So there are a lot of variants. I know young men, especially, but probably young men and women both are being taught. Give a good firm handshake. Don't give them a dead fish. And so some guys, if they're weightlifters, might be overdoing that. The average grip strength is 300 newtons, whatever that means, but that's enough to hold 30.6 grams of weight. Every 50 Newton drop below this was associated with a 16% rise in the risk of death and a 17% increase in the risk of dying, in particular from heart disease. 7% greater risk of heart attack, 9% chance of having a stroke. Among those with cancer or chronic heart disease, the strong grip were more likely to survive the follow-up period. So even if they had the diseases, they're more likely to live. The correlation held when the research is correct for other factors known to play a part, such as age, education, drinking, and smoking. So why? What's the purpose of this? So I say it is impossible to know whether muscular weakness is causing the illness or is a symptom. So is a strong handshake, is that strong handshake, that strength actually causing you to be healthy, or is that weak handshake an evidence that you have something else going on that's making you sick? So I think it's probably the latter. So it matters. If the former is true, then building up your strength of your grip can help you live longer. If it's the latter, then it's probably not going to help you at all. So just working on your grip is not going to make you live longer. I probably think it's the latter. Most likely it's a bit of both. They say I kind of have trouble believing that. With muscle strength, now obviously people who are strong have a better grip. Muscle strength definitely is going to help you live longer, but it doesn't say the grip is making you live longer. It's saying that exercising with anti-aerobic exercise, weightlifting, helps you live longer, and that also gives you a strong grip. So an advantage of his method is it's easy to execute. So these type of measurements are cheap and can be used with minimal training. So the hospitals, doctors can use grip strength as a simpler way to assess if someone's becoming fragile. Now, obviously, if you know that, you might have a different grip than your normal grip. So I have not had that type of test run by a doctor before. So I'm not sure that's come into the medical field yet or not. All right, so there's our mortality statistics. There are a few articles in the class notes on mortality and mortality tables. If we have time in the class, I'll come back to them because I think the actuaries really need to see them. But if we don't, I would encourage you actuaries look these up. You can find other ones that are a little more recent and actually read through them. I have a couple of them out there where I have the highlighted notes, so you don't have to read the whole thing, and you see what changes are coming in and building mortality tables. I think it would be really good as an actuary major. You have some familiarity with mortality table. All right, so the last thing we have here is benefit of survivorship. So let me move this down here below everything else we've done. And let me just define it. This comes from the class notes. And we've already seen it because I've been giving you some longevity products. But the benefit of survivorship, what we're talking about here is the benefit that the life insurance industry has because they can offer life contingent products. Here we're going to focus on the annuity side. People living longer benefiting from people who die early. Life insurance is the exact opposite. People who die early are subsidized by those who live longer. But I'm going to focus on the benefit of survivorship, the annuity side. You calculate it using mortality tables. And essentially what you're doing is you're comparing an investment product, a CD, that pays you whether you live or die. If you die, it goes to your estate. If you live, you get the money. Compared that to a longevity product that only pays you if you live. And we want to look at the difference in these two products, and the difference is going to be that benefit of survivorship, the advantage that life insurance companies have. And I'm hoping you're seeing, I really like that product we did where you get your premium back if you die, and you get $50,000 if you live, and that's more than you paid in, or you get $5 million, and you get $5 million if you make it to 90. I love that product. How do you get a product like that? Well, that's the benefit of survivorship. A bank, an investment firm cannot possibly create something like that. You need a lot of people to die to get that benefit of survivorship. So what we're going to do, I'm going to actually stop this early, and so you can actually look over these notes and do the math yourself as practice before the next class. But what we're going to do is compare a really unusual product, a 30-year zero coupon CD. We're doing zero coupons, so we don't have to worry about reinvesting the interest and all that. We're just keep it really simple. And we're going to compare that to a pure endowment. Pure endowment, what that means is if you die, you get zero. If you live, you get the money. And here, so if you live, you get $10,000 plus interest, and we'll figure out the value of that. And so what we're going to do is we're going to figure out two ways. One is the $10,000, the maturity value. This says invest. No, I'm sorry. The $10,000 is the investment today. So you invest $10,000 in each one of them. So the question is, how much will the CD mature at, and how much will the annuity mature at? And we'll look at the difference. So that's what we're going to calculate next time. You might read through these notes and see the math, because I think at this point you should be able to calculate everything in here. The CD is easy because you don't have any mortality table at all. You just take the $10,000, raise it at 5% for 30 years. All you got to do is figure out the annuity. So look through this math down here. You see this L60 over L90. That should tell you exactly what you need and the difference. So we'll start here next time and see if we can figure out this benefit annuity, benefit of survivorship. And then what I want to do is talk about why I think longevity products are so important, why the insurance industry needs to start offering this product, even though very few of them want to enter it, to offer it.